here. So while he's
Well, there
good
we
morning.
go.
There we go. There's my boy. So Asher, it's good to have you on, man. Um, yeah, so let's visit this morning. Just kind of let everybody know what we got going on this week. We got Asher training today with annuities, and he's going to be going over an illustration that he and I worked on. I think so, anyway. Um, and then we'll be talking about that, how we structured it, what that looked like, why we went the direction we did. So that's going on today. Tomorrow. Um, we have, remind me, what do we have tomorrow? Jane, it was, yeah. And then Friday, I'll just say Friday and then we'll go back on Thursday. Jane, tell me what we set up for tomorrow. But then on Friday, we have, the CEO talk, right? And so we're going to be doing a celebration. I want to do something special on Friday. I just realized I was talking to Jonah yesterday, trying to get the Fridays all put together. Friday's going to be more of a celebration. We're going to call it our Momentum Reunion, right? So all the people that spoke at Momentum, we're going to try to get them to come back and just do maybe a 10-minute segment of our key speakers anyway, and get them to say hi to everybody. There was a lot of people maybe on here that wasn't at convention. And so we're going to try to get them just jump on there, say hi to everybody, encourage, pump, motivate people like Nick, Eric, Nate, Jonah. I told Jonah to get a song ready. He might have to sing for us. And but we're just going to have a reunion, kind of a fun celebration on Friday. And with that regards, I want to do something different. It said it was Halloween, and he said, I'm going to be dressed up. It's Halloween, so don't, Jonah said that, and I laughed. I said, dude, I didn't even realize that. So how cool would it be that we're recording all these videos? What if we all went out and got a crazy wig, right? So like you might see me in some kind of mullet or something, but let's just have fun with it, right? And have a Zoom call with all of us with our crazy wigs on and yeah, ears, whatever, rabbit ears, bunny hats, anything you want, mask. I don't care. Just cover the mug up or whatever you want to do. But let's have fun on Friday. I think wouldn't that be cool? If we all did that and had a whole Zoom full of just crazy characters. And so I think we're going to do that on Friday. Friday celebration. And Jane, what did we have for Thursday? Why am I drawing a blank here? Um,
Trisha's
Trisha.
Veterans Advocate.
how am I forgetting Trisha? Oh my God, Trisha, if you're on, I'm sorry.
I
Uh,
won't tell her.
so, oh my God. Veterans advocate. Well, we've been working on that for a little bit now too. So we've been working with Jonah on getting our very own veterans ad running. And as soon as it's up and running, we're going to roll out Veterans First all over again. You guys know that that was the company that really, when I started uh, with Agents First and started this when I left the other IMO, we were running veterans campaigns. And that's the one I was doing more production I've ever done in my life. I love the veterans market. And and then Trish and I wound up building this company called Veterans First. So we built it together and it kind of took a back seat for a while. We're bringing it back. And tomorrow, you don't want to miss it. If you ever wanted to serve veterans in terms of life insurance, do not miss tomorrow's training. But with no further ado, Asher, man, let's talk annuities, right? So you did a
Talk some annuities.
great
Yes,
job
sir.
at the momentum, and my people come away saying, dude, they love to transfer milk and all the stuff. That was a crazy way of illustrating, right? We loved it. So
Yes.
here's what we know, man, with Asher and his team, that we get access to these guys and we don't have to split comps or anything like that. They're here like, dude, what do you want and how can we help you? And I love that, man. What a blessing that is, right? So, Asher, it's all yours, man. Go ahead.
Love it. Thank you very much. And I thought I had a hard time stop, but I don't. So please let me know whenever we need to get to the next thing, and I'll be good. But yeah, really, guys, we are 24/7 as far as me and my team. So sometimes it may be that you're in a house at 8 p.m. on a Saturday and you have some questions. If that's the case, reach out to me. Whenever I give my number out, I give out my cell phone number. I don't have just like a office line. But man, it is good to see everybody here. Big Red, I recognize Daniel. Who else do I recognize? Who else from the conference? I know I recognize a number of you guys. I'm not getting the names. Oh, Gail. Gail, it's good to see you. She's in the car right now. Man, all right. Well, here's what I'm gonna do. Like Darren said, I want to go over an illustration because I think it's one of the best ways to understand what it is annuities even do. Oh, Katrina, good to see you. It's good to see you. I want to go over an illustration because really it's one of the best ways to understand an annuity is to run some, sample illustration and go over it. Like I said at the conference, most illustrations are really all just copycats of each other. And that's because there's been some legislation that has basically said every illustration has to do it this way. And so really, once you understand one or two of them, that's about it. And it doesn't take much to understand it. I want to start with a quick story, kind of explaining the story behind annuities and why income is so important in retirement. So, if you give me one moment here, and please feel free to come off mute if you guys have any questions, butt in, because now that I'm sharing, I won't be able to see the chat or anything.
Hey, Asher, when you get a chance, can you put your number in the chat? Because I know Nate and I want to have you come on SWAT and do something with us with SWAT.
Oh yeah. Let me. I'll put my number in the chat right after this if you can remind me.
Okay, perfect. Thank you.
But yeah, no, and thank you. I appreciate that. So once again, the brief history of lifetime income, and it's so important to understand this because one of the main selling points that annuities have is their income. That's really how annuities even started. Is back in the day when they first came on the scene, they were only income. There was no other components, and so we kind of go back to the basics here. But I want to start with the OG of lifetime income in America. Oh yes, I'm not a lawyer. I'm not a tax guy. The OG of lifetime income in America is Social Security. Social Security came around in the 1930s, right? And here's what it aimed to do is in our nation, we had a problem with poverty among our seniors. And back in the day, 50%, literally half of all of our nation's seniors were living in poverty. And so you guys might have heard the expression before of someone getting, quote unquote, taken to the poorhouse. The poorhouse was a real thing. This is actually a real image from the Social Security Administration. But they were these big compounds where if you couldn't afford to live on your own, it was much cheaper to live here. They put a ton of people into one room. You shared a bathroom. You had meals that looked more like cardboard, and ultimately, it looked more like a prison than it did any suitable living arrangement. And something else you might notice from this photo is that, fellas, we kind of know the story, right? We end up dying first most of the time. So really, it was just a bunch of old women in these poorhouses. And most of the images you look at, you'll see it's 80-90% women. But basically, this is what our nation's women had to look forward to is, they raised the next generation, they worked tirelessly, and then at the end of the day, half of them would be living in poverty, and a lot of them would be going to a poorhouse. It was a sad, sad reality. So Social Security comes on the scene and it says, we want to give a little bit of lifetime income to our seniors. And we want to give not enough to replace their entire working income, but just a little bit. And just like this, poverty rates among seniors drop from 50 down to 35%, down to 25%, down to 15, all the way down to where it hovers today around 10%. And in fact, if you look it up, kind of what I mentioned before, it doesn't aim to replace everything, but Social Security, and I Googled this back in 2023, but the average Social Security check back then was $1,800. Today it's around 2,000. I'm gonna just pose this question out there because I can't see you guys, but could anybody here live off of 2,000 a month?
Absolutely not.
Absolutely not. Maybe if I go live in my parents' basement, I think I could live off of 2,000 a month. But the truth is, it's just not enough, right? And it was never meant to be. In fact, I like showing these Google screenshots because I'm not saying take my word for it. I'm telling you, go look this up. If you look up Social Security replaces what percent of income, you'll see the Social Security Administration.gov. Are the ones telling you that Social Security only aims to replace about 40% of what a person makes. And for most all Americans, 40% is not nearly enough, right? In fact, they will tell you that in order to live an adequate retirement, you need about 70% of your working income. So if you need 70%, Social Security only gives you 40, then that means you need an extra 30% outside of Social Security. And here's kind of what that looks like. Let's say me and my wife make 100,000 a year combined. If our Social Security checks cover 40%, that's about $40,000. That means I need another 30,000 outside of Social Security just to be made whole. And so here's how it used to be. Back in the day, you would have your Social Security, you'd get a little bit of income from Social Security, and you get a little bit of income from your pension that you had at your job. And together, those combined, and it made enough income to live comfortably in retirement. But today, unless somebody works for, say, a union or the government, do you know anybody with a pension? You probably you
Nope.
probably don't know anybody with a pension because pensions, for the most part, went extinct after the ERISA Act came around. This was in the mid 1970s, and basically a couple things that happened. Uh, One is we started living longer than ever before. Back when Social Security started, you got benefits starting at 65. Life expectancy was 70. So Social Security really was only planning to pay you for a handful of years. Now today you can get benefits at 62, and life expectancy might be in the 80s for you. It's not too uncommon to see someone live to 90. But you had Social Security, you had your pension, and this gave you enough income in retirement. But once again, pensions have really gone extinct at this point. And so now we have Social Security and just you, right? And there what came to replace pensions were 401ks. If you work for a for-profit company, once again, we're going back to the serial now. 403bs if you work for a nonprofit, 457s if you worked for, say, the city, say you were the dog catcher or you worked as the mayor, and a thrift savings plan if you are a federal employee. So maybe you're from the Army, you have a TSP. But all of these are essentially the same thing. They're just a savings account for retirement. They just go by a different title depending on what type of employer you had. But once again, these plans came up and replaced pensions, and they're just savings plans. And what about IRAs? Well, you can think of IRAs basically as the universal vacuum, where once you get to retirement, you suck up your 401k, your 403b, your 457, your TSP, and you roll all of those plans into your IRA. And once it's in your IRA, poof, it becomes your main retirement account. Now, the challenge is we just have to make it last the rest of our lives, right? Because once again, the question is, will it last? Back in the day, you could answer this question pretty confidently because you knew that your pension would pay you until the day that you died, right? But today we don't have that. Instead, we just have a bag of money, and it's up to us to basically distribute it out over the rest of our lives and hope that we don't pull out too much and run out of money in our later years when things get expensive. And so let's say if we were to play this out, let's say I have my magic crystal ball here, and I'm telling you that in 1 year you're going to die. Well, what you would do is you'd pull out that whole IRA, you'd spend it all this year, and you will have played it out perfectly. Let's say if I told you you were going to die in 2 years, you would pull out half of it this year, and you'd pull out half of it next year. You'd spend it all, and you will have retired perfectly. You can play this out for 4 years, 6 years, 8 years, 16 years. And the truth is, knowing when you're going to die would make this so much easier. Retirement planning really is one of the hardest things to do when it comes to the financial planning world, just because you have no idea when you're going to pass. We have no idea. Back in the day, if I could take y'all back, one of the greatest basketball players of all time is Sir Magic Johnson. Back in 1991, what did Magic come out saying?
Yeah, HIV.
He had HIV,
positive.
HIV positive. And back in 1991, that basically meant you were dead. That meant we got another year with him, and then he is going to be gone. And funny enough, he is alive and well today, 30, 34 years later, right? We have new treatments to different cancers. We have a cure, actually, to Hep C. And the point is, once again, we are living longer than ever before. And these things that just used to kill us back in the day, we're discovering ways to outlive them. And so once again, life expectancy back 100 years ago was right at like 70. Life expectancy today is somewhere in the 80s, and it's only going to keep increasing. And so this problem of how do we make our money last has only become harder and harder. And in fact, just for the fun of it, if you Google the first person to live to be 150, a lot of sources say that they've probably already been born. Right. So once again, we don't know how to divide up this bag of money. And let's say you pull out too much, or you end up living too long, and you only plan to live to 85, and you end up living to age 95. What you have done is taken your golden years when you're supposed to be enjoying retirement and spending it with your grandkids, and you've replaced it for the golden arches. And I found the meanest looking old dude I could for this. But this is reality for some people. If you go to Walmart, you see the 85-year-old greeter at the front door, there's a good chance that they just ran out of money in their retirement account. Or for some people, in their retirement account, they get $100,000 and they think they're rich and they think, well, I can just ride off into the sunset with this. And it's not the case. And you'll be stuck asking, do you want fries with that for the rest of your days? And they say, all is well that ends well. Well, if you end up working minimum wage as an 80-year-old, it didn't end well, right? But wait, let's say the same situation happened where you ran out of money in your IRA, but instead your IRA was inside of an annuity. Instead, what happens is you have an endless supply of lifetime income, where even after you've run out of money, the insurance company, the annuity, will continue to pay you until the day that you pass. And once again, that is why people love annuities, is because annuities, kind of like a lot of other forms of insurance, are governed by the law of large numbers. So what does that mean? It's kind of like with, let's say, car insurance. If today I go out and I drive my car and I crash into a Lamborghini, right, and I total it, I have not paid enough in car insurance premiums to pay for that Lamborghini. But with that being said, that insurance company will still cover the full cost of any repairs or replacing that car. And the reason for that is because those repairs are paid for by all the people who didn't get in a wreck that day. And it's a similar deal with annuities where the annuity carrier will put a certain amount aside for reserving, and all the people who end up outliving their money are partially paid for by all the people who didn't. And so it works really just like any other form of insurance does. So that's a quick story I want to tell because it's almost repurposing what the point of these qualified plans is to our clients. That's a little bit of how I start every appointment, is because I tell them once again, this 401k, it came to replace pensions. From the day that it was born, its entire purpose in this world was to become income again. And nobody on earth retires off of an interest rate, right? They retire off of an income amount. So that's
Dude, that was solid, great training answer. I knew you'd bring it, man, and you did. I'll put chats if you have any comments on what he just did. He's getting ready to go into an illustration.
Oh, here, yeah. Before I do that,
Yeah, before you do that, let's talk about what he just said while it's fresh on our mind. What do you guys think? How was that training so far? You liking it? Are you understanding? Did it clarify a lot for you?
I have a question.
Mhm.
Yeah.
What you're saying is that the law of large numbers, that everybody, like if you don't have your annuity set up correctly, and it in my mind it's like if I don't set it up correctly, I may run out of money. But you're saying that I won't run out of money because of the average of law numbers.
Yeah, well, and really what it is you won't run out of money due to this thing called an income rider.
Mhm.
And so basically
Okay.
what it does is, it's an add-on to a policy. Not all annuities have it. Some annuities are just meant to grow, but an annuity with an income rider, say you turn the income on, even if I run out of money, if I live to age 110, or if I'm the guy that lives to age 150, then they will continue to pay me for the rest of my life.
We're actually going to show that because the illustration that
Yeah.
we're about to go over, that was one of the scenarios that we wanted to play out. So we're right on target. So why don't we go ahead and go into the scenarios
Sure.
that we laid out? And I've got the veterans first advocate herself, Trisha Brown. I'm going to tell you this story as he gets ready for this. Trisha brought a client to me. Her and I had worked on a client called the Myers family back with Veterans First. It was on a $15 lead, So this is what's amazing, guys, is that you never know when you establish great clientele and they love you as an agent. Every once in a while, they're going to reach back to you and they're going to say, "Hey, I come across some money," right? And that's what happened in this scenario, and to the point of between 2.1 million and 3.1 million dollars that they want to do something with, that they came in across an investment. They called Trisha. They said, "Trisha, can you help me?" She said, "Well, I know the person that can." So Trish and I are going to be working on this. So I'm going to fly down to Florida on December I believe, 6th. Is that Trish? Unmute yourself. December the 6th. And we're going to be going over this annuity. So I called Asher and I said, "Asher, help me out, man. What do you think? This is a scenario that we laid out." And Trisha, are you on? Is she?
Yes.
Okay. Trisha, would you lay out the scenario that this young lady has, and so that we can tell them what we told Asher? How
Well,
old is she, and her husband,
yeah,
what she came into? Tell us about it.
basically, sweet veteran family, up north on a very, very restricted, long time fixed income, with the husband having some pretty severe health problems now. His estranged sister in Chicago, um, after many, many years, a great uncle, going down. I guess, his parents passing, and it came down to those two people being the heirs. There was two or three different strip malls in a very commercialized place in Chicago, downtown Chicago. And after, I think it was like 18 months of the city trying to track these heirs down, between him and his sister, they inherited, quite a bit of money, and they started to sell these off. And these are later in life people. So they had no idea and were just presented this about 6, 7 months ago, that they had basically owned these buildings. And the sister had been a long time an attorney. She was retired, and she's kind of sick. And so she got a real estate attorney involved, and they came to the agreement to sell these properties off and split the dividends. And in the midst of them selling this commercial property, that's when they start, they're going to start seeing a big accumulative amount of money here, I guess, in the next 3 to 4 weeks. And kind of uncanny, one of the buildings that was sold, they went to, I guess, tear down or rehab or something. There was a locker, and the locker had close to $1 million now in gold coins. And it had been left there. Like, this thing was vacant for many, 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 many years. And so now they have these coins and these different avenues of money. And I made best friends with them because, one, I cared about him, but about 3 months ago, he lost the way to be able to walk. And my mother had for here years one of those handicap scooters, and they didn't have the money. And so I drove it up to him, in the back of the truck, and we got a battery for it, and we left them the scooter, and they were just so, we weren't doing nothing with it, and it just made an impression, I guess, on them. And so when they needed financial help, lo and behold, I'm not necessarily the person to call, but they called me, and they said, Trisha, this is what's going on in our life. And we don't really know who to trust. And a couple banks have called us, and people are telling us to buy crypto coin and blah, blah, blah. We don't even know which way to go. And we're scared. They're literally scared. And I said, well, I'm going to get somebody involved that's smarter than me in this that we can trust, and don't talk to anybody else. And that's kind of been our
That's
way of
good.
life.
And that's great, great. And we'll build on that tomorrow when we're talking about veterans advocacy and what she did, like things that she does above and beyond that nobody else is doing. That those are type of stuff that Trisha does, and that. But you can see how it comes full circle. Okay, so having said that, I call Asher. I say, Asher, here's the deal. This is the lady, what they come into. He said, well, what do we want to do? Right. So the first question is, what's the purpose of the annuity? And we talked about, well, we want to make sure that she doesn't outlive it, but she has around, what do we say, Ash, around $60,000 in income, something like that,
Yeah.
54,000. And we want to make sure she never loses the amount of income she currently has, even after her husband passes away, because he's not in good health. So that's kind of build that. And then she had like, how many grandkids did we say? 5 or 7 grandkids. We wanted to make sure at Christmas time, all the grandkids are giving a something like, like a little gift for the rest of their lives. So giving that scenario, she wanted to help her grandkids, but she also wanted to make sure she had money to live on and never had to not worry about it. And then she wanted to leave a legacy behind. So those were the scenarios that we gave Asher.
Yeah. Yeah. And no, I mean, how unique was that? There was a lot of things that I still am shocked whenever I see it, and that scenario was one of them. I'll tell you what. So never heard of the gold coins being found in a locker. It's like a movie thing.
Well, it's in Chicago. I think isn't that back where some of the mafia guys were? But I'll stay out of that one. But
Well, we're not asking any questions. No, no way. Well, and that's the thing too, is you really never know who's going to have that money. And I'll tell you, one of the biggest cases that we've seen, uh, and just from this year, was a little over $1 million. It was from somebody who ran a final expense appointment.
Mhm.
Funny enough, final expense appointments, you go in there and you will end up arguing over whether or not they can afford $30 a month.
Yeah.
And this agent at the end of the appointment, they asked one question, and it uncovered that the person inside their 401k, they weren't a lawyer or doctor or anything. They just were a nurse. They had worked at the same hospital for basically their whole lives.
Mhm.
They had this giant 403b, because once again it's a nonprofit. If you guys remember the cereal, but they had this giant 403b that they'd never touched. They understood it's for retirement. And it was one of our biggest cases this year, just because all it took is an agent asked one question. And so I'm gonna go over that question at the end of this, but before I do, I want to get into uh, just a sample illustration. And this is actually, I believe, the same product that we ran for that scenario. Darren, is just this Evolve,
Mhm.
but yeah, the same thing. So I want to, I'm going to cover this a little quickly, but kind of in the same sense of how I would cover it with a client. Is I'm only really going to go over a few pages, right? This whole illustration in its entirety is 20 something pages, and there's graphs and charts and more graphs and more charts. And at the end of the day, my number one thing is I want to simplify, because if I confuse a client, sale is over. It doesn't matter how good the product is. And so this whole time, I'm going to simplify, and I'm going to really only go over a handful of things. Number one, hey, Miss Johnson, one of the things that you mentioned to me is that you wanted your 401k protected from the market. You said that the market was scaring you right now. You had no faith that in the next 5, 10 years it's really going to be up at all. What we did is we found a solution where if the market is ever down, you will never ever lose money because of it, right? Another way to say that is we got a 0% floor, right? This is also going to, their 401k has not been taxed the entire time it's been growing. When it's moved over, it's a non-taxable event, and it's going to continue to grow that same way, right? It's going to pay you a lifetime income that you could never ever outlive, even if you run out of money. And last but not least, this product is going to pay a death benefit once you pass. It's going to go to your kids while avoiding probate.
Huge.
And we say that I think that's one of the most skipped over points of annuities is that they are probate free. And I know we talk about probate as life insurance guys already, but I was looking it up just because I couldn't believe it. But if you look up just the average cost of probate, and this is just from Google on average, the average cost of probate is typically between 3 to 7% of an estate's total value, right? And it gives you, for example, a $750,000 estate could cost between $30 and $52,000. That's just the fee for figuring out where the money is supposed to go, right? That's you're paying the courts and the lawyers and the judges. It takes time, and also probably the worst thing about probate is it makes family members argue. And well, no, I took care of mom more, and I did this, and I paid for that. When I'm dead, I don't want my kids bickering one bit. They can suck it up if they don't like it, but all of my money is going to be going probate free because I don't want to have any chance of a creditor or somebody else butting in and saying, well, no, Asher owed me this much, and it goes to them before it goes to my own kids. So that's one of the big benefits of annuities is, once again, the whole death benefit goes probate free. But an annuity, every annuity you see is going to show you two different scenarios. I mean, every annuity illustration is going to show you two different scenarios. The first is in the worst case scenario. So once again, these products are protected from the market, and when the market goes up, they get interest. That's how they operate. But the problem is, can we ever promise? Can we ever guarantee that the market will be up?
No.
Never ever.
No.
We have as much control over the market as a weatherman has over the weather, right? All we can do is sit and watch. And so when we're talking about what's the worst case scenario, the worst case scenario is that the market crashes every year from now till the end of time. We're saying literally we never get any interest. And so that's what if you notice this first page is called the guaranteed policy values. It looks like this on every illustration. They're going to assume that for forever we get zero interest and zero again and zero again because they're assuming that the market was down 10% this year. It was down 30% this year. It was down 15 this year. But remember, everywhere else in the entire world in this scenario, someone's account value would be bleeding. Inside the annuity, they don't lose a penny. And in fact, with this product, they get a little bit of a bonus. I'm assuming they put in 100,000. They're going to give them 5,000 just for starting it. But let's say if they were to cash out their policy, you'll notice there's a number by any annuity you see, or most all annuities you'll see. This just refers to the term. It's saying, for how long do I have to commit to this product? And with this, it's 14 years. So what you'll see is that, hey, in year 5, if I were to cash out entirely, well, if I have 105,000 in my account value, after taking surrender charges, I'll only be left with 94,000. Or let's say in year 2, I want to do this. Well, if I have 105 in there, I'll only be left with a little over 90,000 after I get hit with surrender charges. And so it's one of the reasons why annuities have suitability is because insurance companies want to make sure that they're not taking a client's bottom dollar, right? Because life happens, and when it does, the client has to have some other place to dip into because inside the annuity, you have access to your money. In any annuity, they'll give you 5 or 10% access to your money every year. But any more than that, and you're going to get penalized. But here's what we're showing is that let's say you never get any growth for literally a decade. And after that decade is up, you start pulling out income. So year 10, this is our annual withdrawal. This is basically our income figure here. You start pulling out 8,249 a year. Well, once again, if you're taking all this out and you never get any interest, very quickly that account value starts to go down and down until it hits zero because you're pulling out income and you are never making any interest to replenish it. But even though you have ran out of money, once again, your account value is zero by the time you're 77, you still receive this paycheck every single year until the day that you die. If you live to age 100 or 110, it does not matter. You will still receive that income. And let's play it out. And let's say, once again, this is the worst case scenario, assuming the market crashes every year, we never get any growth. If I were to die at the age of 85, I've put in 100,000 into this product, and in total withdrawals for that year, for total withdrawals up to that point, I have pulled out 173,000 from this product. And that's just assuming I die at 85. If I die at 90, right? If I die at 90, what is that? Cross here. Then I have pulled out over 200,000. I've over doubled my money. And once again, this is the worst case scenario. It couldn't get worse than this. So it's hard to not understate that. But once again, worst case scenario. But the likelihood that the market crashes every year for the next 20 years is not likely at all. I think if that happens, we're probably going to be more concerned about the zombies outside than we would about anything else. And so the worst case scenario, could it happen theoretically? Of course, but it will never happen. I feel very safe saying that. So number two, this is the second scenario that insurance companies are allowed to show, is they say, well, all right, if that doesn't happen, if the last 10 years were to repeat themselves, what would this product look like? And so that's the second scenario that this illustration, and once again, every illustration on Earth is going to show. They'll say, all right, from this period, 2014 to 2024, if this were to repeat and repeat and repeat, what would this product look like? And here is where we can finally see some interest coming into the account, right? So year one, well, they're assuming the market's down. And so instead of taking a negative, once again, the client just gets a zero. Year two, the market was up and you got some interest. The next year, the market was up, you got some interest. And you might notice a pattern here. A lot of these are 8.25. How this would work is that we have a 0% floor and we have a cap of 8.25. Basically saying if the market is up 10%, well, we're capped at 8.25. Let's say the market was up 5%. Well, then we get that full 5%. We get everything up to our cap. But you can kind of follow through and see what they're assuming here. But what we'll notice is that our account value actually starts to grow. And by the time we're at age 64, the year right before we start taking income, we are at 168,000 inside of our account value. And when we start pulling out income, we're pulling out 13, call it 14,000 a year. And once again, this is just off of 100,000. If you wanted to see what 200,000 would be, just double all these numbers. But here's something I want to throw out there. Off of 168,000, let's and for figure's sake, let's call it 170. Off of 170,000, how much income would a normal person be receiving off of that? I'm going to look up something here. And I'm going to say the 4% rule. If you guys have ever heard of this, the 4% rule is generally accepted. A lot of financial advisors, a lot of brokers are going to be talking about this. and it's an older rule, but I think it's still the best thing that they can come up with. It basically says if you pull 4% of your account out every year, you adjust it for inflation, hopefully it should last you about 30 years. Hopefully. There's a chance it won't, but hopefully it does. And it's not just one source saying this. This is Charles Schwab. This is, let me go down here. This is Smart Asset, CNBC. This is a bunch of banks. This is Bankrate, Prudential, Mass Mutual, USA Today, Investopedia. Everywhere you look, the 4% rule is basically the standard in retirement. And so if we were to follow that, and let's say, I remember this was at age 64, this client had 170,000 inside of their account value. How much should they be pulling off if we follow the 4% rule? Can someone help me out with that?
$6,800.
6,800. So if this person followed the 4% rule, they would be pulling roughly 6,800 annually, just in income. Now, once again, let's go back to what we have in our annuity. 6,800 would be about the income figure we're looking at. This annuity is not showing 6,800. In fact, it's showing, is that like double 6,800? Or it's a little over double 6,800. And so, once again, we're not talking about 4%, and we're not talking about hopefully it'll last 30 years, right? Our value is that this right here is, I think, a little over 8% of our account value. And we're saying we guarantee that it will last for the rest of our clients' lives, no matter what. No matter if they live 30 years or if they live 40 years, it doesn't matter. Even after somebody runs out of account value, this income will continue to show up, rain or shine. And let's play it out. Let's say, kind of like what we did in the last scenario, this person lives to age 85. All right, well, there's nothing in the account value to pass on to your kids, but you have pulled out almost 300,000 just in income from this policy. And once again, you started this with just 100,000. You've tripled what you put in. And if you live to age 90, it only looks better. At that point, you've pulled out 360,000. And let's say you end up not living too long, right? You don't live to 85, you don't live to 90. Let's say you just pass away at 70. Well, at that point, you have pulled out, what is that? 83,000, almost everything that you've put in. You've pulled out 83,000, and you're still leaving, this is your account value here, you're still leaving 130,000 to your kids. And remember, it goes to them avoiding all probate. Avoiding the probate courts. And so that's the value that these income annuities have is, let's say you end up living too long. Well, then good news, this annuity is going to work great for you. Let's say you died too early before you could really enjoy that income benefit. Well, then good news, this annuity still worked for you. That's the benefit of going with them. So, do you guys have any questions here?
Asher, do they have access to any of that money during the annuity? I think, like, aren't they allowed to pull out like 10% if they need to, if something comes up?
Yeah, most annuities are 10%. This annuity is 5% because it gives a little bit more benefit. But basically, that's just saying that, hey, let's say at age 60, you needed to pull out some money. Well, then you could pull out, let's say 132 is your account value. You could pull out about 6,500 as a free withdrawal.
Free withdrawal.
Yeah, and a lot of annuities are 10% too. So, usually in this, off of that account value, you could pull out about 13K.
Yeah. Questions, guys, so far?
I have a question.
Yeah, let's see.
All right, so
Here we go.
since this is a lot to comprehend and
Yeah.
understand and whatnot,
Yeah.
so Asher, how much do you charge if we were to, if I had a client who got money that wants to put into an annuity, but since I don't know this and I don't
Yeah.
want to sound like an expert because I'm
Right.
not. How
Yeah.
much do you charge if I brought you in to help with the sale process?
Yeah, I would just do a small app split of 95%, and then you would keep the other five.
Oh,
I'm
wow,
I'm
that's
I'm
great. I
That's
mean,
my kind of humor. I like it.
I'm only joking. We don't do any app splits.
obviously.
If you pull me in and you have me help explain things on the illustration, I don't take any cut. And really it's not a burden to me. So because here's how it goes too, is that I'll come in and do like two or three basically presentations to the clients, and an agent will, they'll get the language, they'll understand the words to use, and it doesn't take long before they're like, you know what, I think I got this next one. I'll call you if I have questions. So really, don't be afraid to get me in on any of these.
Guys, the answer to that is send him a gift card to steakhouse or something after his he doesn't even ask for that, but trust me, on that 3.1 million, Trish and we're gonna send him a few gift cards.
No, no.
But he said he would do the illustrations in front of the
Yeah,
family. He put me
yeah,
on a Zoom call. Guys, that's what we got with this. It's not like he's not taking your money. He wants to
yeah,
help. They pay him to take care
yeah,
of us. And
yeah.
we've got a great rapport and relationship. Next Wednesday, we've got Chris Miller, Asher. Chris is a super good dude, right? You guys work together.
Love
Uh,
Chris.
Not Chris. Okay. Well, I think it
Oh,
was.
no, I said I love Chris.
Oh, you
Sorry.
love Chris. I think
Yeah,
I'm like, okay. Well, Chris is going to be on next Wednesday. Teach us IULs.
love it.
Guess how much comp level he's going to ask for a split? Zero, right? That's what they get paid to do to help us
You
out.
sure it's not 95%?
Hey, but if you want to give me that, I mean that's all right too.
Love it.
Hmm.
Here's and I apologize. I want to get to if there's any other questions. If not, I
I
was going
have
to
a
get in.
question, Asha.
Okay, I love it. Yeah,
First, I'd like to say I have never heard a training like this on annuities, and I've heard several of them. Thank you. Awesome job. So my question is the lifetime income rider. So if it's not put on, can it go back and be added as a rider on? Or do the agent have to do their due diligence of actually adding it on?
it's a great question. Most everywhere you look, you have to add it at the start, and most policies today, at least, will come with a income rider automatically attached. So let's say that product I just showed you, that Evolve, it comes with an income rider, and you can't even take it off. But let's say you put them with an annuity that doesn't have one. I don't know of anywhere that will let you add an income rider after the fact. You would have to basically move them to a different annuity at that point.
Thank you.
Yeah, and thank you for the kind words. And two, I'm going to put my number in the chat. Let's see.
And Asher, as you do that, thank you for doing this today. But my
Of course.
question to you
Yeah.
is, how does when you do a joint annuity, how does that affect the illustration or the play out down the road? If you, let's say, have a husband and wife type thing, one of them passes away,
Yeah.
what does that look like?
That is a fantastic question. Typically, how that looks is you take a reduction on your income, but instead the income lasts for both of your lives. And let's say it was my IRA, right? My wife can't even be a joint owner on that because it's an IRA, it's an individual retirement account. But with that being said, I can still do joint income. And what that will look like is, let's say the income I was going to receive is 10,000 a year for the rest of my life. Well, then if I do joint income, that might drop it down to 8,000. But instead, if I die after 10 years and my wife lives another 20, that income will continue for the rest of hers. And here's an interesting part of that is that on an annuity application, they don't ask any questions about health or what you've been diagnosed with or life expectancy or anything of the sort. So let's say I'm not going to make it too long. I might have another 10 years, and I'd be lucky if I make it that far. What I could do is set up joint income so that after I'm gone, my wife might live another 15 to 20. She is covered for the rest of her life. So honestly, great question.
Yeah.
And can you get creative with parents and children or grandparents and grandchildren? Does it have to be
You
spouse?
can, as far as joint income, it has to be spouse. But there are other ways if, say if a grandparent is setting it up for a grandkid, that we can get creative. But
Excellent. Thank
yeah,
you.
yeah, for sure.
I have a question.
Esther, quick question. You go first, Fred.
But go ahead.
Okay, Esther, real quick, what does this policy cost to someone who's not setting it up, but this person who put in 100K or rolled over
Right.
100K? Is there a premium for them? What does it cost?
Man, that's a fantastic question, and that's something I get a lot when I'm talking to clients is almost just that, hey, it looks great, but it almost sounds too good to be true. And I remember when I first got in the industry, I didn't realize that that was a real objection, and so I'd hear that and I'd be like, I know it's great, right? And so it looks too good to be true because once again, there's seemingly no cost to it. Here's how annuity carriers are able to figure it out. If you go to, say, a brokerage house and you put your money with them, at any point you can take your money away. But the trade-off is that every year you're paying a 1% fee or a 1.5% fee just for them to manage your money. Inside of an annuity, you might have noticed there was no fee whatsoever. Now, some annuities have a fee if, say, their income is a little bit better than what we just looked at. Um, but the one we looked at had no fee. And so the point is that an annuity carrier certainly isn't doing this for charity, right? They're making profit off of this. But the way they make their money is by holding onto yours for a long period of time. It's kind of like how a bank makes money off of a CD. It's spread based where you have to commit to, let's say it's a 2-year CD or a 3-year CD. You have to commit to that length of time. And if you're able to make that commitment, then the annuity carrier, then apologize, the bank is able to make it profitable. And it's the same deal with an annuity carrier, where if you can commit to 14 years, or with this one, I chose 14 years. I just went out the longest that I could. There are some that are 5 years. There are some that are 7, 10 years. There's so many different options. But if you can commit to whatever that time frame is, the annuity carrier is able to make it profitable just because they're working off of a little bit of a spread from your money.
All right, I have my question now.
Yes,
So I
sir.
got a client that has um a 401k that is sitting in Fidelity,
Okay.
and it's been there for like 2 years, just sitting there. How do I get that? How do I write that annuity?
Yeah. So is this somebody who's left their employer?
Yes.
Oh, what did Daniel say in the chat? Daniel,
Milk.
I'm gonna send you something. I'm gonna send you what we call a love box. We call it love box. I can't tell you what's in it. I'm actually gonna send it to you, Daniel. You gotta send me your address because the rollover milk, that's how you get that money.
Yeah,
But
but how do I roll over the number? That's more the specific question.
no, I apologize. I'm gonna
Yeah.
go further into it,
Don't
but
send Daniel anything. That was a given. That was too easy.
it's too
Right.
easy.
But
Yeah,
that was
he
came
should have
from
known
his
that.
training. That came from his training, guys. And anyone that with that momentum 2025 would have known about the rollover milk. What a great analogy. Gutierrez, spot on. So, like the way he broke this down, guys, at Momentum 2025 was classic. Very good, well presentation. But the rollover milk will you'll always stick with you. So I see where you're going with that. Good job.
So here's basically all of what it looks like is the first step is we have to actually write the annuity. So we do that before moving the money or starting that process at all. So step one would be we write the annuity and we send it to their underwriters for them to approve or deny. Because once again, it kind of like life insurance, annuities have suitability that they have to go through, and it's different questions that they ask, but it's still suitability. Once the policy is approved, so let's say I send the app into Silac, they approve it. Then what I do is I get on a phone call and I literally will on Google I'll look up Fidelity 401k account services number. I'll get on a phone call with the client, either physically in the room with me or just a three-way call. And I'll tell them, hey, block out 20 or 30 minutes because I plan to spend most of that time on hold. But if you get through, once you get through, it really only takes 5-10 minutes. And I ask basically two to three questions, and that will get the money moved over. Is once I'm on with the 401k representative, I'll say, hey, this is Asher Molina. I'm Mr. Johnson's insurance agent, and we're calling about 401k policy number, whatever. They'll have to verify that the client is who they say they are, and then I'll ask, is this 401k rollover eligible? Rollover eligible. I have to use those words because I don't want to call it a distribution. I certainly don't want to call it a withdrawal. That type of verbiage would make it taxable. But if I say, is this rollover eligible? Almost 100% of the time after they have left the employer, Fidelity is going to say, yeah, he's been terminated, or he's separated from service. So yes, it is rollover eligible. And I will ask them, what would the procedure be to roll over the money? Because you would think that it's just this uniform thing where every 401k company is required to do it a certain way. It's not the case. They all pick their own rules. And even sometimes with Fidelity, with a Fidelity account with UPS or a Fidelity account with Amazon, they have different rules as to how they roll it over. Most of the time, what they will do is they will just issue a check and either send it directly. Yeah, they'll send it directly to SILAC, or sometimes they'll send it to the client, but the check is never made out to the client. Basically, on that phone call, they'll say, well, hey, we just issue a check. I'll tell them who to make it out to, and then they send it. And as long as the client's on the line with me, you don't run into really any road bumps.
Yeah, it's just FBO, to the insurance company, for benefit of Asher
Yeah,
for whatever company. Okay.
that's it.
All right,
Yeah,
cool.
that keeps it non-taxable. But the rollover milk, man, Daniel, you're getting something. I can't tell you
Hey, you tell him to
exactly.
get that tattooed on him.
No one can steal my move.
Yep, go ahead,
That's
man.
You
legendary.
got two arms, Daniel. You got two arms, bro.
Okay.
Awesome. And uh if there wasn't any questions, I know I'm probably over on time, but I wanted to go over that last question that I posed to clients to kind of start the conversation. And really, for the most part, at the end of any of my live sales, I'm bringing out this question because you once again, you never know who has money. It could be that old dude who's arguing about if he can afford premium that might have a couple 100,000 in his 401k. Right. So basically, the question is, in essence, what are your plans for pulling out income in retirement? And it's something that might come up just casually through conversation, but I might be talking to someone who's 55, they want to retire at 60. I'm asking them, how are you going to replace your current income in retirement? And that's really all it is. And for a lot of people, here's what they will say is that, all right, well, I'm going to take a little bit of Social Security. I'll pull out a little bit from my 401k every year, and I'll make ends meet that way. And then of course, it's all about follow-ups. Nate's presentation at the Momentum was great with that. But if that were to happen, I'd say, well, hey, if a market drop were to happen, or if you were to live too long and run out of money, are you prepared for that? Are you ready to live solely off of Social Security? Do you think your kids would let you back in and you could live with them if you run out of money? And I love asking that question. The answer is obviously that is like last resort. Never want that to happen, but it's a reality for some people. If they run out of money, if they don't have a 401k, they might have to go live back with their kids. And so I want to make that kind of put that on the forefront of their mind because people don't realize how serious it is to take care of your income needs up front as opposed to wait until you run out of money. So I'll ask them, what are your plans for pulling money out in retirement? And really, 99% of the time you say that, they don't have a good answer. And that is exactly the value that you bring in. Well, hey, it's a really good thing that we met. One of the things I specialize in is turning old retirement accounts into an income source that you could never outlive. If I was able to do that for you, is that something you'd be interested in? Awesome. Well, then, hey, let me grab just a little bit of info. I'll meet with my team, and then I'll see if we can't create a solution for you. And that's all. And then I'll get really all I need for an illustration is you get their age, you get the state that they live in. You probably already have both those to begin with. You get about how much they have in their 401k. And last but not least, you get roughly when they want to retire. If somebody doesn't know, I just assume 67 because that's full retirement age. But you get those four things: how much they have in their 401k, when they want to retire, age and state. And then we can run an illustration. In a handful of days, you can come back to them and say, well, hey, I met with my team. You had mentioned to me that you were not comfortable with the market right now. You thought that it was a little too volatile and you didn't want to risk your retirement assets right when you're at the finish line. So what I did is the solution protects your account value from any time the market drops. Right. Another thing it does, you mentioned that you really didn't have any set plan for taking out income in retirement. The solution that we came up with will pay you an income even if you run out of money for the rest of your life, no matter what. And so, you're kind of going down this list of, well, hey, you told me this. This is what this product does. Yeah, you told me that you recently had to deal with going through probate with your parents' assets, and that was a pain in the butt. One of the things we wanted to make sure we did is found a place to put it where it will avoid probate no matter what. And then once you get into the illustration or talking about the product, it's much easier because it really is tailor fit to what they want.
What would you
So I
guys
have
go ahead, Jason?
yeah, I had a question about the commissions because I did one on myself, and I get a commission check every once in a while because I add to my annuity, and so I make a payment, and the company that I'm with gives you a max of how much you can do a year. Is that how it is with SILAC? Like how much you could contribute to your annuity? I have like an indexed one.
A lot of annuities, they're so different. SILAC actually doesn't allow you to contribute after the first year. So some will allow you, like what you have, will allow you to contribute for years down the road. SILAC, it's just the first year. There are some even that you can only do the initial contribution. So I would say, if that's ever what a client wants, we'll just find a different carrier, but SILAC really wouldn't be it for them.
So,
Oh, okay. Thank you.
knowing we do have multiple carriers that we use with Asher's team, and so if we ever run into a scenario, we're going to just transition to another one. We get to pick. That's what's great about Agents First is we have the opportunity to broker with lots of different companies and carriers, and Asher and his team, there'll be multiple carriers we'll use with those guys. So. How would you guys like to see Asher maybe one day a month come in and visit with us? Would that be good? You guys like that? Asher, I don't mind to put you on the spot, but maybe we can work out a deal. I can send you a steak dinner one day a month or something. Yes. Would you mind doing something like that?
No worries at all. Honestly, you guys are awesome. You bring the energy. The conference, I still will never get over it. It was amazing to see everyone rap on stage. I've never seen that. Never seen that. I don't think I ever will, probably. But
It was so good.
Hey,
I would
Asher,
love to do that.
I just want to chime in. I think I've seen 500,000 of these. You have just brought such make sense to this that I feel like it's a desire to do it now, and help in a
Yep.
different vertical because I think that all of us have had the peer or someone say, well, just make sure you're asking, their client, find the money. And it's like, okay, we ask those questions. What do we do next? Like, what is
Right.
this? What is this unicorn that is annuity? How do
Yeah.
we touch it, cook it, massage it? Like, I think it's just been that. And
Yeah.
this really like so many different scenarios today. I've just thought about there's people I know right now that
Mhm.
I probably could have already approached because of just some of the nuances. And
Right.
Helen, the queen, she was just talking about just asking about the writer and just different information that
Yeah.
I think that I've been asked. And I actually have just kind of like told the client, well, let me get back to you. Let me find somebody to get back to you because you don't
Yeah.
want to seem unknowledgeable. Or if it's something you can't even give that person. I think that this training has just been supersonic. So I just super appreciate it.
Man, you were way too kind. Thank you so much, Trisha.
Thank you, guys.
Um,
Well
and
done.
and
Okay, I got a question right fast. I wanted to say, I know you said about the different states when you're writing the person. Some
yeah,
states do have common law, and I know you said it had to be a spouse or something. Would it go by states with common law because that's some of their laws? And also for the age thing for 401k, when you hit the age of 59 and a half and you're still with the job, you're able to deduct from that 401k. Can you deduct for the 401k and still do an annuity while you're still at that job? Or you
oh
have to be released
man,
from that job?
who's Lisa? Lisa, that is a great question. Yes, most of the time, in fact, not even 59 and a half. Sometimes it's 55 that you can start rolling out money from it. And it may be that you can't roll over the full amount, but you can do a partial rollover. But that's the thing. Even if somebody is still working at their job, because once again, all these 401ks have their own rules, and when they set them up, they set up the rule with that employer. So once again, Fidelity has 500 different rules because they have 1,000 different businesses that they work with as far as 401ks. But yes, that's why every time we basically just ask them, and say they're still working there, say they're a 40-year-old still working there. I might say, well, you know what? It's worth a shot. Let's take a few minutes and I'll call them. I'll say, hey, is this account rollover eligible? Well, no, it's not. Is any part of it rollover eligible? Well, this sub account is. And so maybe I'll get that, but maybe it's just that they say no, it's not, and I tell them, hey, well, hit me up when if you ever leave this job. But it never hurts to ask. Great
Great.
question.
Yes. Guys, Asher, tell us a little bit about your, and we can go ahead and stop recording here if you don't mind, but
Yeah.
let's talk personal. So your dad, tell these guys who your dad is. So like he is
Yeah.
the Mr. Annuity. And so
Yes.
guys, it didn't fall far from the tree when it hit Asher, right? So he stayed close to that tree, his dad being the tree. Tell us a little bit about who your dad is. I've heard great things about him.
I'll tell you what, he's hard to miss in a crowd. That might be the first thing I say. If you ever seen him, you know exactly what I'm talking about. He's a very big guy, but yeah, he's Mr. Annuity. He's been doing annuities since 1988, I think is what he says. And so he's been around for forever. And really, what he has done is just found a way to put it all simply. Because once again, I promise you guys, I'm not some genius or whatever on this. I've just listened to what he has to say, and he makes it simple. I basically I dropped out from college to come do what I'm doing now with my dad, and that's how I got my start is just learning about annuities. But really, it doesn't take very long at all before you get the verbiage down, and after being in front of just a couple of clients, you'll really understand. All right, these are the selling points. This is what I got to harp on. Uh, but yeah, that's really what I can say about him is that he can take literally anybody. He can take a college dropout and teach them annuities and make them proficient enough in it.
Well, let me tell you, the reason I bring that up is we don't just have Asher, but we got Asher and his dad, right? And we got the team.
Yeah,
Asher
yeah,
doesn't know. He's going to like, hey, dad. But I've heard his dad, and what was his first name? It's Melina, but
uh-huh.
uh,
Mark Molina.
Mark Melina.
Yeah,
But guys, his name is synonymous in the insurance industry with annuities. If you've ever been in annuities, you've heard Mark Molina and people talking about him. So we've got some really professionals on our side, and what a great opportunity for us to have that partnership. So man, I just wanted to throw that out there and shout out to Mark and to Asher, and
thank
know
you.
that we've got these guys on this team. I love it,
Yep.
guys. We're gonna cut this loose. Diane Moore. Any last questions before we go? David, did you have something or anybody else? Comments?
Yeah, I was just going to now on annuities, like some states, we still got to get that 4 hour education or something before we can write an annuity.
All states. Yeah,
Yeah.
and if I could butt in just 30 seconds here,
Go ahead.
with annuities, you only need a life license. You don't have to have anything else.
Right.
But as far as CE goes, if you're in just about any state, you need a separate CE that's called a 4 hour best interest training. If you're in California or I think Iowa, I think they have their own It's 8 hours, but every other state, you just take it one time and you're done. It costs you about $20. It says 4 hours. You can get that done in an hour and a half if you're really moving, but that's about it.
Yeah, and get with me if you have that question. I'll help you figure out how to get those quizzes in place. And then there's always carrier training you have to do as well before you can submit with the carrier. The carrier will have you do that as well.
Yeah.
But we'll work with you when you're ready to get to that point. We'll help you get that. So don't worry, we'll walk you all the way through every step of the way. And no issues. I know Asher's got a lot going on, and we're so appreciative of his time. And thank you, Asher, for being on here. We'll see you in about another month, and we'll do it all over again, man. And have new questions, and maybe hopefully by then we get 10 or 12 different cases that you've helped us with, and we can kind of go over some of those, and wouldn't that be a blessing? So thank you guys for being on this call. I did want to say there is going to be a little bit some cool stuff that we're rolling out, but rebranding a few things and be thinking of the word surge and think of electricity and all this really neat stuff that you're going to be rolling out to you probably on Friday. So really some neat stuff going on inside Agents First and some just kind of rebranding ourselves a little bit. I think it's going to be really, really cool. Momentum going into 2026. So love you guys. Thank you, Asher. Thank you so much, man. We'll be in touch. And thank you for being on. If you guys remember, we got Zoom calls all throughout the day on all these different breakout rooms. Just find you a room you want to be in. Love you and get on there and just have fun. I'll be hanging out in Coach White's office. We'll see you around.
Thank you once again.
Thank you, Asher.